What if everything you were taught about money is backwards? What if the habit you're most proud of is quietly keeping you stuck?
They told you to save your money. They told you to be responsible. They told you that if you skipped the coffee, avoided debt, and put cash in the bank, you would be safe. But what if the very thing you were taught to do is quietly making you poorer? In America today, saving money the traditional way is no longer the guaranteed path to security it once was. It feels safe because your balance goes up. It feels smart because you are not spending recklessly. It feels disciplined because you are delaying gratification. But while your dollars sit still, the world around them keeps moving. Inflation does not sleep. It does not take weekends off. It does not care how hard you worked for your paycheck. Every year, the cost of food rises, rent climbs higher, insurance premiums stretch your budget thinner, healthcare becomes more expensive, education feels further out of reach, and quietly, the purchasing power of your saved dollars shrinks. You might look at your savings account and feel proud seeing $5,000, $10,000, or even $50,000 sitting there. But if inflation is rising faster than the interest your bank pays you, you are losing money without realizing it. If your bank gives you a fraction of a percent in interest, while prices rise several percent each year, your money is not growing, it is eroding. The tragedy is that this loss is invisible. There is no alert on your phone telling you that your savings just lost value. There is no notification warning you that groceries will cost more next year. There is no dramatic moment when your bank account suddenly drops. Instead, it happens slowly, quietly, almost politely. Saving money used to mean building wealth. Now, for many Americans, it simply means preserving what little remains while the system moves ahead without them. The wealthy understand something different. They rarely let large amounts of money sit idle. They buy assets, they invest in businesses, they purchase real estate, they put money into stocks, funds, and ventures that have the potential to outpace inflation. They make their money work while they sleep.
Meanwhile, the average person is taught to work hard, save diligently, and avoid risk at all costs. But avoiding all risk can be the riskiest move of all, because when you choose absolute safety, you often choose guaranteed stagnation. Wages in America have struggled to keep up with rising costs for years. Even when pay increases, it often feels like you are just keeping your head above water. So you save what you can, you cut back on small pleasures, you postpone trips, you delay buying things you need. You tell yourself that one day it will all add up. And it does add up, but not in the way you expected. When you keep large amounts of cash sitting still for years, you are betting that the dollar will remain strong and that prices will remain stable. History shows that this is rarely the case. The dollar loses value over time. That is how the system is designed. A small, steady amount of inflation is considered normal. But normal does not mean harmless. Consider this simple reality. If something costs $100 today, it is likely to cost more in the future. If your savings are not growing faster than that increase, you are effectively walking backward while believing you are standing still. There is also a psychological trap hidden inside traditional saving. When you see money sitting safely in an account, you feel secure. You feel in control. You feel prepared for emergencies. And having an emergency fund is wise. But beyond that safety cushion, excess idle cash often represents missed opportunity. Opportunity is where wealth is built. Ownership is where growth happens. Participation in the economy is how value multiplies. When you only save and never invest, you remove yourself from the engines that create expansion. You become a spectator in a game where others are collecting the rewards. Corporations grow, markets rise over time, property appreciates, businesses scale, innovation generates new wealth, and your money, sitting in a low-interest account, watches from the sidelines.
This does not mean reckless speculation. It does not mean gambling everything on risky bets.
It means understanding that money is a tool, and tools are meant to be used. There is another layer to this issue that makes it even more serious. The American economy runs on debt and growth. Governments borrow, corporations borrow, consumers borrow. New money enters the system constantly. When more money exists in circulation, each individual dollar tends to lose a bit of its strength. That dynamic quietly punishes those who hold cash long-term without growth strategies. In past generations, a savings account might have provided meaningful interest. Today, many banks offer returns that barely register. The safety is comforting, but the reward is minimal. Meanwhile, asset prices often rise far beyond the pace of basic savings yields. The result is a widening gap. Those who own appreciating assets tend to move ahead. Those who rely solely on saving struggle to keep pace. It is not because they are lazy. It is not because they lack discipline. It is because the rules have changed. Financial education in America often focuses on budgeting and cutting expenses. These are important skills, but they are only half the equation. You cannot shrink your way to wealth forever. There is a limit to how much you can cut. There is a limit to how many expenses you can eliminate. At some point, growth must enter the picture. Saving money is still essential for stability. You need liquidity for emergencies. You need reserves for unexpected setbacks. But beyond that foundation, growth becomes critical. The uncomfortable truth is that playing it completely safe in a system built on expansion can leave you behind. While you guard your dollars, inflation quietly chips away at them. While you wait for the perfect moment, opportunities pass. While you focus only on preservation, others focus on multiplication. This does not mean abandoning caution. It means evolving your strategy. It means recognizing that security and growth must work together. It means understanding that money loses value when it does nothing. The goal is not to stop saving. The goal is to stop believing that saving alone is enough. In a world where prices rise, markets shift, and wealth concentrates in assets, leaving your money idle can slowly drain your financial power. The system rewards participation. It rewards ownership. It rewards calculated action. And the longer you rely solely on traditional saving, the more you may feel like you are running in place while the cost of living sprints ahead. The most dangerous financial risk in America today may not be investing. It may be standing still, because in a moving economy, standing still is the same as falling behind.